Hi, this is Walter Montero, and you're listening to this week's edition of the Real Estate and Mortgage Show. Hey, folks, welcome back to the Real Estate Mortgage Show. And as I had promised you last week, we're going to talk about using your RSP to invest in mortgages. And this, of course, would be private mortgages. You're probably wondering, why would you want to do that in terms of using your RSPs to invest in mortgages? Well, I can tell you that mortgages and mortgage investing can be quite lucrative. There's a private mortgage market out there that people have been investing in for years. For the most part, it's been sort of a secret that bankers and trust companies typically don't want you to know because they want to sell you mutual funds and stocks. So they want to kind of keep you away from this type of investing because there's not a lot of money in it for them, but it can be quite lucrative for you. You're probably wondering, why would you invest in private mortgages? Well, private mortgages definitely have a place in the marketplace, especially today with all the changes that have happened in the mortgage market, all the rules and regulations that have been implemented by the government, obviously to try and curtail any housing bubble and that sort of thing. So the need for private money now is probably greater than it's ever been in quite a few years. Quite honestly, finding these opportunities became somewhat of a struggle because the banks were so aggressive with their mortgage products that the opportunity for private mortgage investors was pretty slim. But the opportunities are greater now, and so anyway, I want to show you, or I want to talk to you about how you can use your mortgages or use your RSPs to invest in mortgages. I just as a caveat, I did write a book on the topic, and I got a little program that I sell on the internet. By all means, you're more than welcome to go and have a look at it at the RRSP mortgageinvestor.com. But today we're going to give you an overview of what that program entails. I'm going to give you quite a bit of an overview. So, I think realistically, you could listen to this program today and go out and set yourself up to start investing in mortgages. But if you want some more details on how to do it, by all means, go on the website rspmortgageinvestor.com and buy the program. Certainly appreciate it. Okay, so let's start off by going step by step in terms of what you need to do to invest in mortgages using your RSP. Number one is your RSP portfolio has to be self-directed. Okay, so that means you have to have it with a trustee that allows you to invest in mortgages. The three that I know of right now are Olympia Trust, which is the company I use, Canadian Western Trust, and B2B Trust. So if your RSP portfolio isn't self-directed and isn't with one of these three companies, the chances are you probably cannot invest in mortgages. So you have to have your money self-directed, your RSP money self-directed, and it has to be with one of these three trust companies. All right, so that's step number one. Step number two is the money that you have in your RSP has to be in a cash ready position in order to be able to invest in a mortgage. So in other words, you can't hold, you can be self-directed and you can be with one of these companies, but you can't have that inside of some sort of locked-in certificate or a mutual fund because quite honestly, you can't invest that in a mortgage. You need cash in there. So you got to do one of two things. Either put more cash into your RSP if you have the room for it, or liquidate some of the investments that you have in your RSP into a cash ready position. Now, I want you to be careful with that because sometimes doing that can create some serious penalties for you. So please be sure that if you are going to do that, make sure that that you're clear on the penalties you're going to pay, because some of those mutual funds can have a lot of teeth in terms of redemption fees and that sort of thing. So just be careful with that. So either liquidate what you have in there or put more money in there. All right. So the next thing you want to do now that you have a self-directed RSP account, you're in a cash ready position. Step number three is to reach out to the mortgage community, and the mortgage community being the mortgage brokerage community, and let them know that you have money to lend. Okay, so you can simply do that. Today's day and age, it's pretty easy. I'd say probably the easiest thing for you to do is just to go on LinkedIn. Do one of the advanced searches, look for mortgage brokers in your vicinity. You can go right in there and punch in your postal code and go out 10 miles, 25 miles, 50 miles, 100 miles, and you can decide where you want to lend money. Okay, reach out to those mortgage brokers in those communities and just let them know that you're a private lender, that you're looking to put some money out on the street, and you usually we'll have a set of guidelines that I'll cover with you in step number 6, but you want to stipulate what those guidelines are and just let them know that you're ready, willing, and able to invest in mortgages should the opportunity arise, and give them your contact information and take it from there. Okay. Now, step number 4 is, of course, you want to set some rules. Okay. I did say step number 6 because step number 6 does cover that a little bit. But step number 4 is basically you want to set some rules. You want to decide, first of all, if you want to be a first mortgage lender or a second mortgage lender. Okay. I don't suggest you be anything other than that. Some people are pretty aggressive in going into third position. Okay. I don't advise that. But what I would say is first or second position on a mortgage is pretty safe. Okay, so what I would do is, say, for example, with myself, my set of guidelines is I don't like to go beyond 85%. They call LTV, which is a loan to value ratio. So just to give you an example of that, if I'm putting a mortgage on a property, and as I had mentioned to you, I'm a second mortgage investor. Okay, and I have a property worth $100,000. Now I know what you're thinking. You're thinking, Walter, where are you finding a property worth $100,000? Well, there isn't one, but this is for the sake of the example. Okay, so if I have a property worth $100,000, and there is a first mortgage on the property already with another lender, say for $55,000. Okay, that means that the loan to value on that property now is 55%. Okay, which is of course the 55,000. My rule of thumb is I don't like to go beyond 85%. So that means that I would be willing to lend this person another $30,000 on that house. Okay, which would bring the value up to 85% loan to value, if you see what I mean. Okay, so you may not like that value. The community we're in here, obviously Cambridge, Kitchener, Waterloo, we're in a pretty, aggressive and robust market. If somebody gets themselves in a jam, I feel pretty comfortable in being able to sell the property relatively quickly. So I don't think that my position is really in danger. The reason there's a buffer there, of course, is because you want to make sure that the borrower has some skin in the game, first and foremost, and number 2, you want a bit of an insulator in terms of expenses, that if you ever did have to take that property back for whatever reason, well, the reason being, of course, that they defaulted on the mortgage, you want to make sure that there's enough room for all the expenses that are going to be incurred with unloading that property, like the real estate fees and the legal fees and property taxes and all that kind of stuff. So you want to make sure that that money is in there, because if it isn't, you're going to lose some money. So you got to make sure that you set the rules straight in terms of how you want to lend. So if you're not comfortable with 85, go to 80. You don't like 80, go to 75. But just keep in mind, the lower that ratio is, the less likely you're going to have opportunities to lend money. Okay, unless of course you go into first position, which really changes the rate game. Okay, you get you get a far better return on the second mortgage market than you do on the first. Okay, so that is number 4. Number 5 is go over the opportunities. Okay, so you've reached out to the mortgage community, you've set some rules, you've got some cash. Now you're probably going to be presented with some opportunities from the lending community. Okay, so go over the opportunities and assess them. Okay, and the way you're going to assess them is by step number 6, which is measuring a few different elements. One is called the TDS ratio, which is the total debt service. The other one is loan to value. We kind of already did that when we set the parameters in terms of our rules. And the other thing, of course, is credit worthiness, so credit bureau of the borrower that's looking to borrow the money, and then of course the subject property. Okay, the subject property is really important here because you want to make sure that you're dealing with a true value of the property, and what I mean by saying that is that you want an appraisal on the property. So in other words, this number that they give you, that they say, hey, this property's worth 100,000, and really in the open market it's only worth 85,000. well, then the 100,000 was a lie. It's all for naught. You don't want to base your decisions on a lie. You want to base it on actual facts. Okay, so it's very important that you're very comfortable with the value of the property. Okay, and you can do that a few different ways. You can get an appraisal, and you want to get an appraisal from a licensed appraiser, not just a realtor. Okay, and I'm a realtor. I love realtors, but realtors sometimes can be wrong. Okay, so they can be a little bit pie in the sky in terms of value. So you want to make sure you get an appraisal either from a CRA or an AACI. Somebody with those designations, so you're comfortable with the value of the property. Now you base those decisions based on that value. So let's go back to what I was talking to you about in terms of, I said TDS and LTV. TDS, of course, is total debt service. This is basically what this is basically a measure that lending institutions use to determine whether somebody should be borrowing the money or not. Okay, so typically, that number is somewhere around 40 to 44% in the open marketplace. So in other words, what that means is the banks are comfortable with the borrower having a total debt service of up to, say, 44% of the gross income of the individual borrower. Okay, so in other words, if they bring home $1,000, then the lender is comfortable with them using $440 towards the payment of their debts. And that would be all of their debts. That would be their mortgage, that would be their heating costs, that would be their property taxes, that would be any kind of payments on credit cards and car payments and that sort of thing. So that's the number that lending institutions use. As a private lender, you're going to be a little bit more aggressive. Okay, some private lenders don't even care about that number. I would say that that's probably foolish to do, but I would personally, I would not allow that number to go any higher than 50%, because as soon as you go into that area of beyond 50% TDS, you're just tempting the devil, and quite honestly, you're going to end up with some trouble down the road. So you want to make sure that these people can sustain their payments, because in all honesty, these people are only borrowing from you for short term. They're going to borrow it from you on 1 or 2 year terms until they get their act together, because they're going to be paying you a pretty high rate of interest, typically anywhere from 12 to 16%. Now they're going to want to get out of that. Okay, so that's why it's important that when you go over and assess the deal, that you see some light at the end of the tunnel for these people, that there is a solution or an exit plan for them, because the last thing you want to do is get stuck with this borrower for a long time. Sure, you get the return, that's great, but how do you get your principal back? You need to have an exit strategy, and the exit strategy is something that the mortgage broker can help you determine in terms of what they need to do in order to fix their credit in order to borrow from a lending institution again. Okay, and so obviously, that leads me into the actual credit bureau report, which is basically a breakdown of what the borrower is currently indebted on. Okay, mortgages, car payments, anything like that. If they've ever had any challenges, that's going to be on there. If they've ever had a bankruptcy, that's going to be on there. If they've ever had a credit proposal, anything like that, that's all going to be on there. Now, I want you to keep in mind here that the people that are borrowing from you are more than likely not the most stellar in terms of their credit worthiness. That's why they're borrowing from you. But one thing I want you to be clear on is to not lend money to just people that can't handle credit altogether. You want to look at bumps in the road. Bumps in the road type people, either somebody that maybe got sick or lost a job, or something like that, and they're getting back on their feet, and that's the important part here. Okay, or they just started a new business is going well, but they don't have enough time under their belt, something along those lines. So you want to be able to lend to somebody that obviously is in a jam, but at the same time that can get themselves out of this jam once they're done with the need for your money. Okay, so that's what I look at. Okay, hope that was clear enough. Anyway, the next step, which is step number 7, is once you've determined that you're comfortable lending this money to these people on the house that they're borrowing it on, then you're going to set a commitment. Okay, now I just want to back up here a bit before I go into the commitment. I want to go over the appraisal a little bit. The appraisal all by itself is going to be a number, a valuation of the property. Okay, so I don't want you to make your decision strictly on the appraised value. Okay, it's important to obviously have a right appraised value, but I don't want you to make the decision solely on the appraised value. And the reason I say that is because I want you to make sure that the property that they're mortgaging is in good condition and that there's no adverse elements that may cause the property to be hard to sell. Okay, so in other words, if the property is appraised at 250,000 and you're comfortable with a loan to value ratio of 85%, just make sure that this property is not something that maybe could be worth 300,000 and it's all beat up. Now, having said that, in some markets those properties are easy to sell, but sometimes they're not, or sometimes they're in a bad area, or sometimes they're contaminated. They're next door to a plant of some sort, or maybe they had some sort of environmental issues. You don't want to get into any of that stuff. You want to get into good marketable properties that if they hit the marketplace, they sell quickly. Get it? Okay, so let's be sure it's not just about the appraised value, but the condition of the property. Okay, and if you even want to go and look at that property, you're fully entitled to look at that property. So before you lend on that property, go ahead and look at it. If you think that you would feel comfortable owning it, then it's probably safe to loan on it. There used to be a guy in the States that used to teach this strategy. His name was Joe Land. You might want to Google him. I think he still actually has courses online. I'm not sure, but his motto was always, you want to loan to own. Okay, so in other words, if you had to take that property back, you'd feel comfortable owning that property. Okay. Now let's get on to the commitment. So once you've decided you want to lend money on this and you've gone through all your due diligence, you're ready to go, then you gotta put together a lending commitment. Lending commitment, very simply, is that you are going to promise to lend this money for X amount of time, usually 1 or 2 year terms, at X amount of percentage rate, anywhere from, if it's a second mortgage, anywhere from 12 to 16 or even 18%. Sometimes you might want to fee that kind of stuff. Who knows? I mean, there'll be all kinds of different elements there. So make this commitment. There's usually an expiry on that commitment. There's usually some paperwork involved from your trustee as well. Okay. And when you give the borrower that commitment, you give it to them with a timeline. Okay, you got X amount of days to determine whether you want to lend on this mortgage or not. And then if the lender accepts it, there's usually conditions. Okay, and the conditions typically are, the criteria that you asked for can be proved to you. So you might want to see job letters, the appraisal. You might want to see some other debts getting paid out. That kind of stuff. So, whatever those conditions are, and the mortgage broker can go over that with you, then that's what's going to be on your commitment. So, in other words, you're not going to lend that money until those conditions in that commitment are resolved. All right. And then once those conditions, which is step number 8, are satisfied, then what you're going to do is you're going to fund this mortgage. And basically the funding of the mortgage is typically through a lawyer, of course, and through your trustee. So you're going to send the instructions to your trustee, your Olympia Trust, your Canadian Western Trust, or B2B, and then you're going to give them a copy of the commitment, and then they're going to send this money to the lawyer that's handling the transaction. The other thing that you might want to put into the condition is that the borrower is the one who's responsible for paying your legal fees as well. You don't want to incur any more costs because you are going to have a trustee cost. Okay, for each particular mortgage, your trustee does charge you a fee, which you can in turn charge back to the borrower, by the way. Okay, so you can put that all in there. And the other thing I want you to be clear on is you don't have to pay a mortgage broker anything for this. Okay, because mortgage brokers typically charge the borrower. Okay, so this is sort of their little holy grail. I mean, the value of a mortgage broker is not only knowledge of the mortgage marketplace with lending institutions, but having a battery of private lenders. That, I'll tell you, that really gives a mortgage broker a lot of strength. So you're helping the mortgage broker probably even more than he's helping you. Okay, because you're really increasing his arsenal in terms of being able to lend more money and charge more fees. Okay. Some people have a lot of contacts, but I would venture to say they don't. Okay, so reach out to the community. The guys that have a lot of lenders, don't worry about them. Toss them aside. The ones who don't, help them out and make sure that you're comfortable with the whole thing. All right. And the final step is to collect the interest. Okay, that's the hardest part. It's not. This is basically all handled by your trustee. Usually, those things are handled right through the trustee. They collect the payment for you. That goes right back into your RSP. All this money stays within your RSP, and the payments that they make back to you, they go back into your cash ready position. Okay, so they go into your RSP in cash, which basically can enable you to invest more money in other elements, other mortgages, maybe other investments, that sort of thing. But that's it in a nutshell on what you need to do to invest your RSPs in mortgages today. If you have any questions about this, feel free to email me. You can email me at walter@maximumresults.ca. We're also contemplating putting on a webinar just to, make this strategy a little bit more, just to give it a little bit more light. And the other thing is, of course, is keep in mind that we also own a mortgage company here. So if you have money that you'd like to have us reach out to our community and see if we can find a borrower for you, by all means, give me a call. You can reach me at 519-624-9222. Exciting strategy, one of my favorite topics. And as I said, I love talking about it. So anytime you want to give me a call and discuss RSP mortgages, I invite you to. Okay, I hope you enjoyed this week's topic, and if you haven't already done so on iTunes, certainly give us a rating. A 5-star rating would certainly be appreciated. But I hope you're having a great day, and we'll talk to you next week.